So we are coming off what many market people would describe as one of the most important weeks in the global capital market. A week that saw earnings report from 5 of the top 7 largest companies in the world. I'm speaking of Amazon, Google, that is Alphabet as it's known in the market, Meta. Meta is a parent company for Facebook, Instagram, Thread, and WhatsApp. And then Apple and Microsoft. These 5 companies presented their earnings report last week. And they all had one thing in common. All five of them beat expectations in terms of earnings and revenue. However, the market seemed unhappy with some of these reports, specifically Meta, that is Facebook, the company we used to know as Facebook, and Microsoft. The market was kind of displeased with their earnings report. You want to know why? Last week also featured reports from AMD. AMD is one of the chip makers, one of the second largest contributor in the GPU market next to NVIDIA. And we saw reports from them, and we also saw reports from Visa. We also saw reports from 3 healthcare companies that we track, that is Pfizer, Bristol Myers, and AbbVie. Last week, we also saw reports from 3 Nigerian companies that we track, MTN Nigeria, Access Bank, and NASCON. Okay, so this is Market Tape on Street Exchange, your every Monday show for keeping up to date with the Nigerian and global capital markets. As I always do before getting into the day's discussion, this show is essentially for information purpose. Nothing said on this show should be taken as an investment recommendation or a solicitation to buy a security. I have detailed disclosure information about our holdings, my holdings, and those of my team members, as well as every disclosure information that you need to know about this show. You have it in the description segment of all our broadcast channels. So you should do well to familiarize yourself with those. It's important that you know who we are, why we do this, so that you can be guided appropriately. If you haven't subscribed to this channel yet, make sure you subscribe so you never get to miss any of my shows. And we are coming into a very important week. Today is 4th of November, a day to the US presidential election. It's one election that everybody, the market particularly, has been waiting for. To see who comes on top. It's a closely contested election between Donald Trump and Kamala Harris, the current Vice President of the United States. As I always say, elections, particularly in developed markets, could have short-term implications, but in the long term, as an investor, you'll be fine irrespective of the outcome of this election. You'll be fine as an investor, especially if you are a long-term investor. The outcome of the election, whether it's the Democrat that wins or the Republicans led by Donald Trump that comes victorious after the elections tomorrow, it doesn't matter really in the long term for markets. But to a Nigerian, this may sound strange, really, like saying elections don't matter in the long term, because obviously we are dealing with consequences of our choice in Nigeria as a country, the consequences of the sort of leaders we've elected in the last couple of years. We are dealing with those consequences, irrespective of the side of the divide that you choose to belong to. We are seeing consequences for our elections in Nigeria today. So saying that elections don't matter in the long term may sound kind of strange to a Nigerian, but just imagine this. You see how involved Elon Musk has been in the whole Trump's presidential campaigns. He's been head over heels involved in all the process. Imagine a Nigerian businessman doing that. I can tell you one thing. Elon Musk would do all of this, and it won't matter to him who wins. If Kamala Harris wins the election, you can be sure that his businesses would not go down as you would expect if he were to do that in Nigeria. He will still have his businesses running. Speaking of Tesla, Twitter, Starlinks, and all of his business interests will not be impacted as much as it would be impacted if he did that in a developing country where there's more government interference in businesses. But this is the United States, where the institutions transcends political parties, transcends whoever gets elected as a president. So you're not likely to see very large sort of ramifications as a result of how whoever wins this election. But the thing I actually want to touch on is mostly the Trump side, because lately we've been hearing of Trump trades here and there. If Trump wins, which sector would perform? Because you expect that if Kamala Harris wins, it would be essentially a continuation of the Biden's administration. But with Trump coming in, Trump has said that he's going to increase tariff, especially on imported goods. Speaking of EVs, solar systems, and all of those. So he's going to clamp down more on importation and protect American industries a lot. And this has consequences, particularly on inflation rates. He also said he's going to raise tariff locally in the US. He's going to cut tax. He's going to cut tax in the United States, which both of these decisions would have impact on inflation. If he raises tariff on imported goods, you should expect the price of those goods to go up in the United States, which will stoke inflation. And if inflation goes up, then we may kiss goodbye to interest rate cuts. So you will likely see rates start to trend higher upwards. He also spoke about, I think this is for the crypto market. There was a comment he made once that he was going to make United States the crypto capital of the world, which has kind of sent crypto price going up. The price of Bitcoin, for instance, went over $70,000 at some point. It's currently around $68,000, which has kind of created some sort of excitement in that market. So you're seeing more and more people piling into the crypto market. And generally, higher interest rate is bad for the stock market. So if Trump were to win, in the near term, you may see some of the gains we've seen in the stock market, particularly in the tech sector that is interest rate sensitive. You may start to see some of those gains giving up if with a Trump presidency. But where I think there will be more long-term impact is in the bond market, where currently you see yields on the 10 years US Treasury bonds at 4.3%. So I think the bond market is actually pricing in a Trump's victory come this election. The bond market looks like it is expecting a Trump victory. But it's a tight race, and we'll look to see what happens. But a higher interest rate in the US has implications for the rest of the world. Currently in Nigeria, for instance, you see our 10 years bond yields around 21%. And if rates in the US remain well over 4%, then you expect that these rates will remain at these 20 levels for a very long time, particularly in the 10 years, around the 10 years maturity. The longer end of the Nigerian bond market has rates around between 17 and 18%, depending on the maturity you are looking at. And then in the near-term maturities like 2026, 2027, 2026 is currently at 19.5, 2027 is 19.75. So it's a good time for investors, really, particularly now that we've moved away from the era of 2021, 2022, where interest rate was essentially single digit even in Nigeria, and close to 1% in place like in developed markets. Today, the rates are much higher, double digit in most developing markets, and then within 4 or 5% for developed markets. So, and a Trump presidency would mean that these rates will remain at this very high level. So if you're an investor, for instance, in Nigeria today, you are able to diversify better, hold some investment in fixed income and some in the stock market. Obviously, the Nigerian stock market has been on a tear since last year. It did over 40% last year, and currently over 30%. Not forgetting the US market has done, I think, as of the weekend, year to date is close to over 21% year to date. So, but then my admonition would be this: if you want to do any of these Trump trades, whether you want to invest, whether you're looking at the crypto market, whether you're looking at the stock market, whether you're looking at the bond market, stick to your long-term investment strategy. It's very important, because most of the volatility you're going to see is near term. Some people expect that if Trump loses, there may be, we have some risk of, say, a civil breakdown in the United States, which will have ramifications for the rest of the world, But to me, the probability of that happening is slim, But what you're looking at is long term. What happens in the long term is what really matters. And what matters in the long term is, as I always say, fundamentals. Fundamentals is what happens in the long term. The businesses you're investing in, how are they generating revenue? How is their revenue expected to grow in the next couple of years down the line? That is what is important at the end of the day, not who wins this election. So you want to stick to your strategy. If you're not a believer in, say, crypto, I wouldn't be investing in crypto simply because some people expect that the Republicans will have more favorable regulation around the crypto market. I won't invest in crypto for that singular reason. I'll be investing in crypto if I'm a firm believer in the whole blockchain and crypto market story. I'll be investing on that reason, not because of the so-called Trump trades, where I think I've seen on Robinhood selling contracts for people betting the direction of betting on the outcome of the election. So you're not. For me, that is sort of gambling. So unless you're a trader or you're a gambler, you'll be interested in such trade. But if you're an investor, if you are looking at the long term, you want to stick with fundamentals. You want to stick with businesses that you believe in. You want to stick with investment strategies that have worked for you over the years and that you expect to work in the next 10, 20 years. And to me, that is all that matters in the long term. Now, to the earnings that we saw last week, starting with Amazon, we had spectacular performances by these large tech companies. Speaking of Amazon, Alphabet, Meta, Microsoft, and Apple, they all churned out very spectacular results. But obviously, the reception was different from the market. On its part, Amazon saw revenue beat estimates by 1.27%. Earnings per share even performed way better, beating estimates by 25.44%. Earnings before interest, depreciation and amortization beat estimate by 8.66%. So we saw revenue up to $159 billion, while earnings per share came at $1.43. But the real story with Amazon, okay, let me look at the revenue first. the revenue growth year over year, revenue grew 11% from Q3 2023, while earnings per share even performed better, increasing by 52% compared to Q3 2023. But then the remarkable story for Amazon is the performance of AWS. AWS is their cloud segment, the segment that covers their cloud business. AWS revenue grew at 19%, while ad revenue grew at 19% also. So you were seeing that AI, artificial intelligence, which is a subset of their AWS business, continues to impact their revenue very, very positively, growing at 19% overall in terms of their AWS business. That is Amazon Web Services business grew at 19%, and then the other part of their business, ad revenue, which comes from, Amazon runs this e-commerce website where they sell actual products, and retailers also sell their products, and a significant part of that business contributes to a significant contribution of that business is to their revenue, which comes from people advertising on their platforms. The growth came at 19%, and the growth in their ad revenue actually performed better than that of Facebook. Speaking of Meta ad revenue grew at 18.7%. Google's ad revenue grew at 15%. So that is putting that in context. Amazon outperformed these two guys in terms of revenue growth. So overall, their revenue grew 11.04% year on year. And Amazon didn't stop at that. They also gave a very solid guidance for their Q4 report, for their Q4 expected earnings in the fourth quarter. By their guidance, they expect revenue for Q4 to come at $181 billion, between $181 billion to $185 billion. So, and it was quite impressive. The market was head over heels with the performance by Amazon. Year to date, if you look at the return on the stock, year to date, Amazon has done 42.81% in terms of the return on their share price, 42.8%. But one other thing I want to bring out from this report is the fact that their free cash flow actually declined in this Q3, and the reason is simple. They're spending over 22 billion investing in data centers, to enhance their capacity in terms of artificial intelligence and the increasing demand for migration of information from to cloud for many businesses. So AI demand continues to remain strong, and Amazon actually expects that demand to increase come 2025, and they are spending loads and loads of dollars to invest in their capacity to be able to meet that demand. And in Q3, their spending went up to $22 billion, which kind of reduced their free cash flow. Yeah, and if you look at it, and you can't fault them really for spending this sort of, as you see later, even Meta is spending way more than this, and to me, you can't fault Amazon for spending this much, because AWS contributes about 60% to their profit annually, and so you would understand why they are spending this much, just to make sure that they preserve the sort of market leadership they have there. So if you look at the revenue generated by AWS generated 27.45 billion for the company in Q3, which is way higher than what we're going to see with Google and Microsoft in terms of how much they are generating in revenue from their cloud business. So Amazon is the clear leader in the cloud business, and to remain in that pole position, they need to spend, and they are doing that. And the market was quite impressed with their performance. Year to date, as I said, their performance is 42%. But you look at all of this, the tech sector, the conversation in the market lately has been that the tech sector appears to be reaching a very high valuation. But if you look at the price to earnings ratio for Amazon, it's just 42.38. Forward PE is at 38.8, which is nowhere near the sort of numbers you see with Nvidia and some of these other tech guys. So to me, there's still a lot of room for Amazon to run in terms of how high their share price will go, and how much they have the capacity to take advantage of the opportunities that we're going to see in the months ahead. Speaking of demand for artificial intelligence. Now, the next company I'll be looking at is Google. Google also performed well. That's Alphabet. Their revenue outperformed estimate by 2.44%. Earnings per share performed better than estimate by 14.59%. Their overall revenue came at 88.3 billion, and earnings per share came at $2.2 per share. Now, if you drill further, year on year revenue grew at 15%, which was quite decent for an established company like Alphabet. Revenue grew at 15.1%. Earnings per share performed even better, growing at 36.77 year on year compared to Q3 2023. And the major driver for Alphabet is actually their search revenue. Search revenue contributed 49.39 billion and grew at 11%. So look at their segment performance. Google Search, their search engine, grew at 12.7%. YouTube ads grew at 12.2%. Google Network declined by 1.56% compared to last year. Subscriptions, platforms, and devices grew at 27.82%, while Google Cloud, which is their cloud business, grew at 34.96%. And the revenue for the cloud business came at 11.35%, which is about 40% of what Amazon did in terms of cloud revenue. So Google is still playing catch up to Amazon. And I think the major part of their business, really, the current drivers for their business is really the Google search and YouTube revenue, which continues to perform excellently well. And in these two segments, they actually have dominance. We can speak of all the the competition they have for YouTube, for instance. They have competition from TikTok and some of these other guys, but YouTube remains the favorite. I mean, if you want to watch, let's say, like this podcast, where else would you go searching for podcasts other than YouTube? Videos, I mean, educational videos particularly, and today they even have short, they've segmented their platform such that you can have your long form videos and short form videos, and so they have significant dominance in these two sectors, their Google search and then the Google ad segment. But cloud revenue is also growing at a very good clip, growing at 34.96%, which is kind of impressive for Alphabet. Now, there are other bets that they have also going. For instance, the self-driving unit, where they have a company called Waymo that's continued to expand. It's a small contributor to their overall business, but it's worth mentioning. They are betting on the self-driving industry to be able to rival the likes of Tesla and Uber in that market. I think they even have a partnership currently with Uber to kind of advance what they are doing in that segment. But if you look at the price to earnings ratio for Alphabet, the price to earnings ratio is actually very, 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 looks very, very attractive. PE is at 22.7. The current PE ratio is at 22.7, while the forward PE ratio is at 21. And then compared to the rest of the Magnificent Seven, Alphabet has done 33% a year to date, which is better than the market and ranks only, fourth behind Nvidia, Amazon, and Meta, that is Facebook. All right, so moving on, I think the next one is Meta. That is the parent company for Facebook, Instagram, WhatsApp, and Thread. And they also performed better than expected. Revenue came to 40.6 billion, 0.74 better than expected. EPS came at $6.03, 13.77% better than expected. And year on year, their revenue grew by 18.86% from 34.15 billion in Q3 2023 to 40.59 billion. EPS also performed better compared to last year. EPS came at 6.03 compared to $4.39 from 2023 Q3. But now the issue with Meta, at least from the perspective of the market, is the fact that Meta reported that they had 3.9 billion active users. Daily active users came at 3.29 billion, meaning that every day, at least 3.29 billion people use Facebook, use one of their family of apps. Speaking of whether it's Facebook, WhatsApp, Instagram, or Thread, at least 3.29 billion people used one of their apps on a daily basis. But the market expected 3.31 billion people. I mean, I'm struggling to understand this, because really, how many people do we have in the world? About 8 billion. So 3.2 of the world's population use one of Meta's applications on a daily basis, meaning that almost half of the world, close to half of the world, use one of the application on a daily basis. I mean, if close to half of the world is already using your product, you don't expect the growth rate to be very high. You don't expect the number of users to grow by 20% in a year. But compared to last year, they had a 5% growth when you look at this metric. But the market expected better, But to me, the major issue with Meta is the fact that they spent 40 billion in capital expenditure in the last quarter. They spent $40 billion in capital expenditure. And if you recall, when I was speaking about Amazon spent, I think, about 22 billion in capital expenditure. And all of this investment is in artificial intelligence. They're budgeting this money to buy GPUs from Nvidia and to some extent AMD, Advanced Micro Devices. So, and Meta actually expects their spending to continue to accelerate even in 2025. They expect to even continue to spend more money investing in their data center, investing in their reality labs, where they are investing in data centers that train AI models for different purposes, whether it's their search engine, whether it's their other businesses, So the future really, if you look at the sheer amount of money these companies are spending, it kind of solidifies the whole AI story, that a lot of these companies believe that the next cycle of growth is going to come from artificial intelligence, and they are spending loads and loads of money to stay ready for that market. But the market actually thinks that Meta spending 40 billion is on the high side, and that they may not be able to, this sort of spending may not be justified by the amount of revenue that they end up making in the years ahead. So after the report, Meta stock was down for last week. But at the end of the day, I think the beneficiary for all of this is the likes of NVIDIA, and to some extent advanced micro devices, because we continue to hear one thing from these very large companies, that AI is the next, will drive the next cycle of growth, and they're investing massively in artificial intelligence. And what are they investing in? They're investing in hardwares, buying GPUs from NVIDIA and all of these chip makers. NVIDIA will report by next week. Is it next week? In 2 weeks' time, actually. The report comes out, I think, on the 20th of November, and we'll get to see firsthand how much of those spendings that has come to them in terms of the AI spending. We'll see how much of this spending has gone to NVIDIA, and what they think about 2025. Speaking of the upcoming demand, Meta is up about 80% year to date, and it's one of the best performers among the top companies in the world, next only to NVIDIA. Then the next is Microsoft. Microsoft also outperformed estimates. Revenue performed better than estimate at 1.55%. The revenue stood at $65.6 billion, while earnings per share came at $3.3. Year over year, the revenue grew at 16.05%, while earnings per share grew at 10.37%. Their cost of revenue grew at 23.31%. Overall, the growth at 16% is quite impressive for Microsoft. And then revenue from their cloud segment, particularly their Azure, came at 33%, surpassing estimates. However, the thing with Microsoft is that their guidance for next year fell below expectation. And I'll read the comment from their chief financial officer, and he said demand continues to be higher than our available capacity. And I think this is a key word for me if you look at their expectation for next year, because to me that was the main exception that the market took to this report, the fact that they are guiding for lower revenue in Q4 and in 2025. So, but the key issue with this is not that the demand is not there. It's just that Microsoft does not have the capacity to meet the current level of demand that they are seeing. And what do they have to do? Again, what the likes of Alphabet and Amazon has done, and also Meta, they need to continue to invest in their data center, invest in increasing their capacity to meet the expected demand. And he said, demand continues to be higher than our available capacity. And this is from Amy Hood, who is Microsoft's finance chief. So the major issue with Microsoft is not about the lack of demand, it's in the capacity to meet existing demands. So their stock fell for last week. Year to date, Microsoft has returned just 17.19%. They have one of the lowest return among the top 7 companies, the Magnificent Seven. Next, just better than Tesla only. The Tesla year to date is 13.19%. And then finally, for the top companies in the world, we also saw a report from Apple. Apple revenue also outperformed estimates. EPS outperformed estimates. EPS came at 1.64, while revenue came at 94.9 billion. Compared to last year, their revenue grew at 6%. Earnings per share grew at 11.56%. Then if you look at their segment performance, which is where I really want to hammer on, the iPhone revenue grew at just 5.5%. Mac revenue, their iMac revenue grew at 1.71%. iPad grew at 7.92%. Wearable declined by 3%, and their services grew by 11.92%. So across all segments, apart from wearables and accessories, Apple saw their revenue grow, and overall their revenue grew at 6%. So I think what I'll be curious to see, especially in Q4, is the sort of impact the iPhone sales will have on their fourth quarter report. Because if you recall, iPhone 16, which is their latest iPhone model, was launched late September, I think around September the 20th. So we only saw just about a week's sales from iPhone 16 on this latest report. Actually, this is their Q4 2024 report. So I'm speaking of the next quarter, which is Q1 2025. So it will be interesting to see the sort of contributions that iPhone 16 will make to their revenue when they report next. But for me overall, Apple is that company that I think is nearing the end of their life cycle. And what you're seeing is you start to see earnings growth or revenue growth taper off. You get to this point where for every company you have this period of very high revenue growth, and then ascends to this point where you stabilize, and then you're struggling to grow. You're going to try to innovate. You're going to cut costs and apply all of these measures just to see that you remain profitable. I think Apple is at that level in their life cycle. So you're not going to see 200% return from Apple in a year, as you're seeing with the likes of NVIDIA. I doubt that you see that with Apple. So in terms of what you do with this investment, if you already have it, for me, I have it and I'm holding it for diversification purpose. You're going to see in a year 10% growth. If you're happy with that, then like me, you can retain it in your portfolio. But you're not going to see the sort of moves that you see with NVIDIA, with the likes of potentially Tesla and some of these other tech names. You're not going to see those large amount of move from Apple. Now, away from the top 7 companies, from the Magnificent Seven, we also saw a report from AMD, Advanced Micro Devices. Advanced Micro Devices is the second largest vendor of data center graphic processing units, next only to NVIDIA. GPU is what companies use to train large models for artificial intelligence. And in that sector, AMD is the second largest vendor next only to Nvidia. And we saw their report come out last week. Revenue came at 6.82 billion, outperforming estimate by 1.64. Earnings per share was in line with estimate at 0.92. Now, if you look at their performance year on year, I think this is where you get a bit more impressed with what they have done. Revenue grew at 17.59% compared to Q3 2023. Earnings per share grew at 31% compared to Q3 2023, while net income grew at 2.74 compared to the comparable quarter in 2023. Overall, their segment business, we saw impressive performance in terms of their data center revenue, which was up 122% year over year, and their gross margin expanded to 54% as a result of the large move we saw with the data center revenue. So as I said, they are the second largest vendor in data center graphic processing units, and we're seeing how that is impacting on their bottom line. Okay, they also have the PC segment, where they saw a 23% growth year over year. Okay, so they also make, in addition to the GPU, the graphic processing unit, they also make central processing chips for laptops and servers, and that is the segment they call the client segment, which grew by 23% year over year. But relative to Nvidia, for instance, AMD has kind of underperformed. You see, year to date, AMD has done just 26.38% compared to 200% return from Nvidia, and that speaks to the sort of dominance Nvidia has had in that market. Nvidia came out with their GPU for training AI models in 2022. And it was until recently, I think late in 2023, that AMD came out with theirs, to rival Nvidia. At the time AMD came out with their own GPU, Nvidia had already taken over close to 100% of the market. So basically, what AMD has been doing all along is playing catch up. And in all fairness to them, they now have they have businesses from some of Nvidia's customers, like Oracle, Microsoft, and even Facebook, Meta. They have some of those businesses, but most of these companies are still spending more on Nvidia's chip compared to AMD's chip. So if you are investing, to me, if you are looking at the whole semiconductor market, you consider AMD if you're trying to diversify, but the market leader in that segment still remains Nvidia, and I think they will continue to dominate that market for some time, because at this point, if you're a company, you want to play safe, you want to work with a guy who you are sure that everyone who uses their chip has had a good experience. You don't want to go try something new with the likes of Nvidia. So you can understand why most companies favor Nvidia over advanced micro devices. Now, to the other report we saw, Visa is the credit card company. I'm sure we're all familiar with Visa card. Visa saw a revenue of 9.62 billion, which outperformed estimates. Earnings per share outperformed estimate also by 13%. The earnings per share came at $2.71. Year on year, their revenue grew at 11.73%. Earnings per share grew at 15.81%. 15.81%. Overall, it's an impressive performance, driven majorly by their card services and their international transactions, which grew at 7.97% and 9.12% respectively. But if you look at the performance year to date compared to the rest of the market, Visa has also underperformed relative to the rest of the market. Year to date, they have returned 20.29%. And then the healthcare guys, the healthcare companies, three of them reported last week, speaking of Pfizer, Bristol Myers, and AbbVie, and they all outperformed estimates. Pfizer performed better than estimates by 18.79%. Earnings per share outperformed estimate by 73.77%. So for most of these healthcare companies, we saw a slowdown in their revenue post-COVID because most of them invested a lot in finding cure for COVID, and obviously COVID did not last much later than 2021. So most of them have had to unwind that project and look for new areas of investment, which has kind of hurt their revenue and their cost simultaneously. So we've seen most of these healthcare companies underperform the rest of the market. But I think we're starting to see a turning point for most of these healthcare companies. So what we're seeing with Pfizer is something that cuts across most of the healthcare companies today. Their revenues are beginning to pick up and their cost structure is beginning to look good once again. Year on year, their revenue grew, that is Pfizer, by 31.11%, while their earnings per share grew at 723.53%. So impressive report from Pfizer. And but however, their year to date. So if you look at the year to date performance for Pfizer, it's actually negative by 4.85%. Of the three of them that reported, AbbVie is the guy that had the better performance. Total return is 49.24%. Bristol Myers is 8.02%. So if you look at AbbVie's revenue outperformed estimate by 1.4%. Earnings per share outperformed estimate by 2.74%. Year on year revenue grew by 3.8%. EPS up by 1.69%. Cost of sale actually declined from 6.49 billion to 4.2 billion. So it speaks to what I was alluding to earlier on, that many of these guys are their cost structure is beginning to look better than it was in 2021, 2022 post-COVID. In terms of their segment performance, we saw their immunology, neuroscience, and anesthetics go up at 3.83%, 11.84%, and 15% year on year. However, their oncology and eye care segment actually declined year on year. For Bristol Myers, we also saw an impressive performance. Revenue outperformed estimate by 6.25%. EPS outperformed estimate by 20%. Year on year, their revenue grew by 8.39%. However, earnings per share declined 10% year on year. Okay, in terms of their segment performance, oncology, cardiovascular segment, hematology, and immunology, all of these segments advanced in Q3 2024 compared to Q3 2023. So we've seen a recovery in terms of their revenue trajectory for most of these healthcare names. So to round out this discussion today, local companies, MTN Nigeria reported last week. Also, revenue grew by 33%. But one common denominator for most of these companies outside of the banking sector in Nigeria is that most of them are dealing with very high operating cost, finance cost, and issues with the exchange rate. And it keeps showing up in all of these reports that we've been reviewing since this earnings season started. So despite revenue growing at 33%, we saw operating costs accelerate by 62.59%. Finance costs grew by 84%, while foreign exchange loss contributed over 90% to their bottom line. So at the end of the quarter, MTN posted a loss before tax of 713 billion, which is kind of massive. A significant contributor to their overall revenue is their data revenue, which rose by 52.3% year on year. Voice revenue rose slightly by 13.8%. So we're seeing more and more revenue coming from their data segment, but the overall story for MTN is the high operating cost, the finance cost, which went up from 164 billion to 303 billion in Q3 2024. And they also posted an exchange loss, which is even more than what they posted last year at 904 billion. So bottom line, not looking good for MTN at the moment. Access Bank also has had, on their part, they had an impressive quarter. Their interest income grew by 142%. Interest expense grew by 115%. Their net interest income grew by 100.01%, while their profit after tax increased by 65%. So for the quarter, Access Bank posted 209 billion in profit before tax, and their earnings per share came at 479 kobo. With the exception of the banks, most companies obviously are still struggling in the country. And the last one I'll look at is NASCON. NASCON saw a 40.65% growth in revenue. Cost of goods sold increased by 114%, which is the same story with MTN. Operating cost is actually soaring, and it comes from higher exchange rate for a company like NASCON that needs to import certain raw materials to finish most of their products. You have to worry about exchange rate and higher operating costs for the company. So for all three of these companies, NASCON, MTN, and Access Bank they've all underperformed this year. Most of them have a negative return year to date. And to me, I think there are three companies that you want to look at if you're still looking for areas where you can extract value in the Nigerian stock market that has been on a tear since last year. So you could look to these sort of companies that are not in favor currently, so to speak, in terms of investors' interest. You can look at these companies and see if there are values that you can extract in terms of your investment strategy. And the earnings week continues this week. We expect to see earnings from Palantir. Palantir is one company that I talk about this company a lot, and it will be interesting to see what they do with their current quarter reports. We also see earnings report this week from Datadog, Sunrun, Novo Nordisk, Berkshire Hathaway, Moderna, Cloudflare, Lucid, and a couple of other companies. It's been a long one today, and If you made it this far, I thank you for listening. And it's important that I continue to get the feedbacks from everyone who listens to this show. Please keep the feedbacks coming. They are important and it helps us know what you love to listen to, what you love to hear from us. And also keep the questions coming. We'll do our best in future segments to actually answer some of the questions we see in the comment section on the show, to throw more light on them. And don't forget to subscribe.